I'm super optimistic for a number of reasons, but the main reason is that the COVID problem is going to be going away in view of the fact that we now have vaccines that are going to be administered to people all over the world. And just as importantly, the solutions to treating COVID-19 are now being found and used successfully. So I think we will be out of the COVID crisis this year. But another factor is we can see that last year there was an actual shrinkage of the economies around the world. Now, this year, there'll be a positive movement, in other words, a growth. And if you take the minus and the plus, you'll see an incredible surge in growth around the world. And that will give a lot of confidence to the markets. So I think we're going to be in a very good position. The other factors, the winning of the presidency by Joe Biden in the US, and the fact that his strength in both houses of Congress will be very high, will mean that he will be able to spend, and feed the US economy with lots of liquidity. And of course, that will help the rest of the world because that means there'll be more imports going into the US. And of course, the trade war with China will probably be alleviated. And in view of all these factors, you're going to see good growth around the world.
I think in general, there is certainly some amount of optimism going into 2021. And the reason why I say that is because, kind of looking at where we are right now in a lot of parts of the world, that, COVID is still keeping people relatively locked down and in their homes. And, that's keeping a lot of sectors from really thriving, primarily travel, leisure, and other activities such as that. So, should the vaccine, continue to be deployed and that allows some of those, underserved sectors to open up, that could be a real positive, and we could see, a significant shift into spending in those areas, which in general could support the overall markets.
I think it would be sustainable for the reason that the liquidity, as I just mentioned, will be so great. There'll be an opportunity to see markets rise. Commodity prices will rise as well. Already we're seeing some of that taking place. And you're going to see spending increasing around the world, both consumer and industrial spending.
I think in general, yes, those signs of recovery should continue to take hold. I think that's going to be kind of a theme for 2021, is one of recovery. Again, particularly in those sectors that are most beaten down. Like I said, some of the cyclical sectors where, again, people have not been able to participate in those: movie theaters, restaurants, gyms, cruise lines, travel. There's been large restrictions there. So, should some of those things unlock, that should continue the recovery theme. For now, you don't see a lot of disruption because the market does continue to see, number one, it sees a vaccine that's here and is only going to be deployed to more and more people in more and more countries. And number two, it continues to see stimulus support some of those areas of the market. That doesn't mean there aren't going to be winners and losers, and some parts that are up and some that are down, but in general, there are still reasons why the market can look through this recent kind of rise in cases to a brighter point in 2021.
I think COVID-19 was the most serious virus that we had. A lot of people say, well, COVID-19 is not really a virus. It's not like pneumonia, but in fact, it is one strain of a virus. It's a type of virus, and it's the most serious one, but we now have a solution. So I don't think we're going to see anything worse. A lot of people talk about second wave, but I don't think this will be very significant. The fact that the Democrats are in such a strong position with the presidency and with two houses of Congress, they will be able to push through very heavy spending bills. One other aspect I think is important to remember, and that is you have a young generation in the party, in the Democratic Party, who believe in so-called MMT, modern monetary theory. Under this theory, the government should not have any constraint on spending. A government that prints its own money should be able to spend freely because it will always be able to pay its bills. That is the idea of modern monetary theory. And if this kind of theory holds true and is adopted by the Democratic Party in general, then you're going to see even more spending than we expected.
One of the differences over the last 2 months since the election is the potential excitement around stimulus. I think that is something that, from a market's perspective, they like. Certainly more support to industries, potentially municipalities and communities. And, that has kind of overshadowed the risks that are potentially posed by that blue wave, which is potentially increased regulation, primarily on some of the big tech companies, and potentially rise in taxes, and some increased regulation in the energy space. So, again, I think those negatives right now are being outweighed by the focus on recovery, stimulus, and the continued deployment of a vaccine. Look at what's happening already. You've seen some stress in some of the big tech names. You've seen interest rates in the US rise from their lows, particularly at the longer end of the curve. Those are things that could potentially hurt the growth of these kind of high growth companies that have really thrived on, very low rates to really increase their earnings multiples. So there certainly are some headwinds there that could manifest themselves more in the future. But, in the short term, I'd say that's been offset by a weaker US dollar, which has been supportive of commodity prices. You've seen oil prices once again go above $50. Those tend to be good for emerging market assets, those higher commodity prices and a weaker US dollar. So, again, as I said before, there are going to be some winners and going to be some losers. And, over the year, I guess we'll kind of determine which one outweighs the other. The biggest opportunities are probably going to be in areas that, a couple of things. Number one, those that are, geared towards, as I said before, some of that commodity rebound, weak US dollar, which is going to be, again, potentially some emerging market assets. But also I would add that, in some of the more dislocated sectors just in general, which is energy, real estate, utilities, financials. I say financials because you're seeing that rising yield curve. You're seeing the yield curve steepen, which is most beneficial there. And, that those areas that are kind of still geared to the recovery trade, real estate was one on the commercial side that was hit especially hard, where you had offices, you had hotels, you had many of those underlying properties, retail being shuttered or slowed. And it's even in the case of retail, areas that were already under some amount of stress coming into 2020 that was just further exacerbated by the pandemic. So, to the degree that you can take advantage of some of these situations, and maybe some of those that are a little more complex in those recovering assets, should provide good opportunities in 2021.
Well, of course, the most important asset class impacting everything, every industry, will be technology. So the opportunities will be in those industries that are able to use technology to their advantage. This includes, by the way, any of the traditional industries. Already we're seeing in retail trade the use of technology, the use of internet, the use of online buying and selling is very much prevalent. And those companies that have been able to utilize this technology will do very well. but it's true of every industry, whether it be mining, whether it be oil production, whether it be uh, any kind of manufacturing. All these industries will be impacted by technology, and those companies capable of utilizing technology effectively will be most benefited, and therefore the stock prices will do well.
Howard Marks, our co-founder here at Oaktree, just put out a memo where he actually went into that exact topic of how to assess the value in growth versus value stocks, and a history of some of the metrics that are used to measure that. And I think that is going to be a continued theme in 2021. Now, one thing to be aware of is that the winners and the strong companies and the companies that have shown resilience and flexibility in times like 2020 will most likely continue to grow and show strength. But there are certainly areas, again, I mentioned some of them with the Democrats owning a full complement of power in the U.S. There will eventually come around to some concern about regulatory changes, primarily around these large tech companies and social media companies and data and the power that they possess. So, how soon that comes, I don't know. It could become a bigger theme later in 2021, and something certainly to watch out for. The other area is higher taxes in 2021 as well, which could cause, some rotation from assets that have gained the most as investors seek to lock in those capital gains. If they didn't do it in 2020, maybe they do it more in 2021. And ultimately, as I said before, higher interest rates will potentially weigh on some of these really high growth companies that rely on low interest rates, or their high multiples have been justified by low interest rates. So, the other risk is kind of both ways for something like an energy, which has lagged in 2020, but also faces it faces strength in terms of oil prices. Again, as I said, are above 50, but should that again become a topic of discussion amongst the Democrats in power to restrict some of that energy use, you could see some stress in that market. So not all clean sailing for sure, but there will probably be a continued, at least status quo or shift away from potentially some of the high growth companies.
There is a feeling that value will be coming back, but you must remember that value is growth. The idea that you're looking through a rearview mirror to look at previous earnings and then adjusting it for the PE ratio, the price book ratio, whatever, is really out the door now. It's all about growth, and it's all about return on capital. So the idea that you are going to be a value investor really does not hold anymore. Now the emphasis is going to be on growth. Run away from any things that they don't really understand. So, for example, if anybody approaches you to buy Bitcoin, ask them to explain it to you. And if you really understand it, then fine. But if you don't get involved. So this is the same true for any investment. If you don't understand what the investment is, then stay away, because you will be burned and you will be very unhappy having made that decision.
I think from the perspective of a credit investor, you have to be a little bit more concerned about continuing to lend credit into those industries and into those companies that are more reliant on everything going perfect as far as vaccines and improvements and recovery, primarily because a lot of those did attract capital in 2020 with the anticipation at the time that the pandemic would probably be largely over by now. So some of those dates have been increased. So those are certainly areas to be careful of. And also, as I mentioned, some of the higher rated credit areas like investment grade and some sovereigns, that are trading at very tight yields, where, should interest rates start to rise and should you see inflation come back, there isn't a lot of room for error in some of those more what I'd call perfectly priced assets.
This year has started out very well. I don't know whether you've seen the performance, but emerging markets are doing quite well. As you know, India is doing extremely well. They're growing at a very fast pace. And India's population is equal to that of China. So we believe that India will surge ahead to greater and greater things. China still is growing at a fast pace. I think this year we're expecting 6% or 7% growth. Interestingly enough, despite the trade war, last year China's exports were greater than the previous year. So we're seeing continuing good growth in countries around the world.
In general, the weaker dollar, has historically been supportive for emerging markets. Higher commodity prices supportive for emerging markets. I think one of the elements that's, kind of quote unquote different this time is that, rates are quite low in emerging markets. And you guys in Brazil certainly saw this happen over the last couple of years where, your rates have come down to historically low, something that probably would have, been very unexpected a couple of years ago. And that's the case across a lot of markets. So you don't have that kind of yield advantage to draw you into emerging markets like you did before. And I think some of the lingering effects of COVID could take longer to play through in some emerging markets, just given the fact that they weren't as able as some of the developed markets to either apply monetary policy and inject capital in the market that way, or create large fiscal spends to kind of boost the support or restart growth sooner than later. So I think some will certainly thrive, some will potentially lag, and others could continue to be challenged.
Commodity prices will do quite well. We're already seeing some recovery in the commodity price space, and we think that will continue. But you must remember, this is all about currency and currency devaluation. As more and more currency is printed and dispersed throughout the world, then commodity prices will rise.
The China recovery is pretty incredible, and is unlike a lot of the other recoveries we've seen. Their ability to kind of restart their economy back to levels that I don't think at the beginning of 2020 people would have expected to see at the end. And your comment about commodities and growth, certainly they do control a lot of demand for commodities, and their continued striving to meet their longer term goals should be and could be supportive of that. And as long as they continue on this path, will continue to benefit those who are involved in those sectors.
Brazil is among the top four. The biggest is India, followed by Korea, Taiwan, and then China, and then Brazil. So we're seeing some interesting things happening in Brazil. In terms of sectors, we're emphasizing technology again, but in this case, chip design, semiconductor design, semiconductor manufacturing. Then we're looking at healthcare, particularly testing, healthcare testing. And then we have some infrastructure companies that produce products for building any kind of construction. We are invested in BW and into Lojas Americanas and Fleury. Those are the ones that are the most prominent in our portfolio at this time. These companies are very well run. They have good managements. We don't just look at the share price. We look at the management and how they're positioned for the future. And Lojas and B2W and Fleury are all very well positioned going forward. So it's all about management, good management. And by the way, we also engage with these companies to improve their governance because we're very interested in ESG, environmental, social, and governance standards. So we want to help these companies improve their position in the ESG continuum. So this is going to be more and more important going forward. And our research indicates that companies that have good ESG, particularly the G, governance, will tend to have better price performance. I think the main risk is getting carried away with price movements. If you see, in some cases, prices of stocks or commodities move up too fast and become overpriced. So you have to be very careful not to get caught up in the kind of excitement that you see in such cases.
Some of the main risks in general are that the market is really priced with a lot of expectation for a very narrow outcome to be achieved. And what I mean by that is, again, a vaccine to be largely deployed in the first half of 2021, that this will allow companies to, kind of reopen and restart their operations and not have to go back to borrowing. I mean, one of the negatives of 2020, what happened is companies definitely took on more leverage. You saw in the investment grade markets in the United States, you had over $2 trillion of issuance. Not all of that net new issuance, but certainly companies are taking on more debt. In the high yield or non-investment grade markets, you had a record amount of over $400 billion issued in that market. And, a lot of that early on in April, May, June, and July went to companies that were, really struggling and really needed the cash flow to get them through this situation. You saw it with cruise lines, you saw it with theme parks, you saw it with airlines, these most impacted companies. So, they're going to have the drag on their earnings of that increased cost of financing and paying down that debt. And second of all, they're hoping that they don't have to dip in again and that things start to open up. So, I think some of those risks are, if anything slows down that recovery, you could see, some of those companies continue to be challenged. And that's why I say it's difficult to get excited about, adding more capital into some of those markets until we have a better picture of the recovery. And another risk I would say is we're uncertain of how, people's behaviors are going to be changed and altered for the longer term. For example, we've talked a lot about, the potential demand for a lot of these shuttered businesses and industries in the cyclical sectors, for example, and that can cause a real resurgence into 2021. But we can't overlook the fact that consumers still spent, particularly in the US. The government was very generous with their stimulus, despite unemployment rising and salaries falling. Personal incomes were actually higher in 2020 as a result of stimulus. And even at this point, I think on average about 20% of incomes come from some form of government support. So, they spent that money on a lot of goods, on a lot of home goods, on a lot of home renovations, on, gardens in their homes and baking at home and groceries and things like that. So, are some of those going to fall again to allow the consumer to spend more on some of these other areas? I think some of those behavioral questions are, people are going to be interested to see how they shift and change permanently as we go further into 2021. Inflation is definitely tied to that very fine line that I think central banks, particularly those in the developed markets, are trying to walk right now, where you want to find that right mix of monetary policy, of fiscal policy that, keeps your FX rates in check, it keeps your interest rates in check, and ultimately keeps inflation in check. And as we know, inflation can come from, a few different factors. Obviously, high demand for a good, that is more scarce can drive up inflation. But if you get inflation on the side of the producer who's selling you that good, that just wants a higher price because they, potentially, aren't as excited about taking in U.S. dollars because the dollar's weakening, that you could also see a lift in inflation for maybe, less positive reasons. So, those are definitely very valid risks to track. I mean, and you have a Fed in the U.S. that has basically announced that it will let inflation run above its set target as they've taken more of an averaging approach to inflation. So, again, there's a really kind of fine line that's being walked by a lot of these politicians and central bankers right now to kind of get all that right. And again, in conjunction with the just the economic recovery, vaccine, the things we talked about before. Hedging will largely depend on the type of portfolio that we have. I mean, the best hedge for that is superior underwriting and focus on avoiding loss. Oaktree's investment philosophy #1 that Howard and Bruce penned over 25 years ago highlights this exact point: is avoiding loss. And the tagline that they say is, if you avoid the losers, the winners take care of themselves. And that's really what we strive to do in all of our portfolios, which is why you have that balance of lower risk names. I mean, one thing that you want to certainly try and find is good income generating assets at a time like this, which will kind of smooth the volatility over, the potential for some of these more esoteric or more complex assets. I mean, the road to recovery in commercial mortgage-backed securities may not be a straight line up in 2021. So you have to be prepared from that. And again, by balancing your portfolio amongst these lower vol, lower risk assets. And if you looked at our portfolios in general, especially those that can be measured against a market benchmark, for example, you'll see us taking less risk in most cases than those benchmarks would show.
Yeah, I think it's important to have some gold in your portfolio, but you must remember that gold does not pay dividends, does not grow as a company's earnings can grow. So gold is a form of currency. And as you know, currencies around the world always devalue, whether it's US dollar, euro, whatever, they will always be worth less tomorrow than it is today. So it's important to have gold, but most of the portfolio should be in equities, because equities keep up with the devaluation of currencies. The best way to protect it is ensure that you do your research or have a fund manager who's doing the research, and to not be trading too much. You should invest for the long term. If you buy something, you have to convince yourself that it's a very good investment and then stay with it. Don't worry about the price from day to day or week to week.